So, officially, welcome to the Opportunity Zones Meetup. This is an event that I put on about twice a month. We started back in October of last year, just before we had the state convention on community opportunity zones out in Aurora. And our purpose here as a group is to share information so that everyone, and particularly communities, because these are distressed economic communities, can take advantage of the new legislation that creates incentives for people to take their capital gains and roll those over intentionally into communities that could use some economic help and put that money into a local business or property development that will contribute to the economic activity and growth of that particular community. So my name's Karl Dakin. I am the host, mentor, sponsor, and whatever for this particular group. And my background is that I've done 40 years in new business startup, licensed attorney, work with all kinds of businesses in all kinds of industries, but most of the time I'm being asked to help put together capital campaigns for people who are trying to match up with money for their particular enterprise or project, which could be a government program, it could be nonprofit, could be for-profit, property, or business. And I became aware of Opportunity Zones early last year as an alternative form of capital funding and a potential resource that particular communities could take advantage of. And so I started trying to learn as quickly as I could. And so finally threw my hat in and started this group in October of last year. We just crossed to 150 members in this group right now, which is great because you're not all in the room here who are members. But one of the things we do, as you can observe, is we do a video recording of each of these sessions. And after this is over, it's edited and posted on my channel, the Karl Dakin channel, on YouTube, where it can be downloaded by anybody in the United States. So we're continuing to build our viewership, continuing to build our library of materials. And as far as I've been able to tell, there still is not any other group in the United States who's at this level of detail and this much volume. And I keep waiting for a major law firm or a CPA firm to just kind of blow by me with a bigger budget, but it hasn't happened yet. So for the moment, we have a tentative lead in an unknown race. So thanks to everybody for coming tonight. We're going to talk about opportunity zones, and tonight's program, we're going to talk about matching investors with opportunities. As I was sharing with some people earlier, that I work with capital campaigns all the time, and there's an automatic common rejection rate between people seeking money and people with money in the ordinary capital industry. And as an example, on average, 98% of the applications for funding to angels are rejected. Okay, only a 2% success rate is the national industry norm, but for some reason we're seeing an even higher rejection rate in opportunity zone matches. And part of tonight's program is we're going to share information on what that might be a cause, how we might solve that, different solutions that some of you may have come up with. And with that, we may even talk about other things we might do as a group or teaming with someone to put together better systems, better platforms, better tools so that the matchmaking efficiency goes up and we'll spend more time doing projects rather than trying to find a partner to work with. So again, thank you all for coming to this particular meetup. My firm, as I mentioned earlier, primarily works with putting together capital campaigns. That means I'm not a broker-dealer. I'm the person who tries to figure out who loves you more than you love yourself so that we can go talk to them and tell a story to them that they want to hear, and you do a deal. This is what brokers do for a commission. I'm the person who helps put together the story, the packaging, and tries to point a project in the right direction so we can do it quicker, better, cheaper. Also, one of the projects I'm involved in is also acting as a sponsor. This is the Sugar Beet District project in Fort Collins. It's a planned 50-acre mixed-use development that is intending to create a live-work design capability that we're calling human permaculture. a fitting of human life with the planet in a way that makes it a desirable place to work and live. And so we're trying to use net zero across the board, and we're currently in property acquisition mode, and as soon as we get one or more of the properties under contract, then we're going to launch our Opportunity Zone funding campaign for the initial fund. And then as this project rolls up, it's primarily funding the horizontal development. Each of the tenants will be able to conduct their own individual campaigns. So we may see 20 to 30 follow-on Opportunity Zone campaigns on this particular property before we're all done. So that's one of the projects in which I'm directly involved today, and with any luck, by next program, maybe I'll have another 2 or 3 to add to the list. So projects, funds, and investors, part 1. For those of you who are just learning about Opportunity Zones, its legislation was passed in 2017 that said that if you took money you gained from a sale of a capital asset, or capital gains that would otherwise be taxable, and you roll that money into a qualified opportunity, which could be a business or property, then you have the ability to get certain incentives for doing that. One is you get a deferral in paying the taxes on the gain that you just recognized. If you leave it there long enough, you get discounts off of that tax liability. And the big winner for everybody is if you leave the money there for 10 years and remain qualified during this entire time, any gain or appreciation on that new investment is tax-free. So we've had prior programs where we have talked about what you can do in property. We've talked about what you can do with high-flying, fast-moving businesses with high potential. And we've also talked about innovation hubs as kind of a hybrid between real estate and businesses, where you have a chance to kind of get the real estate, I'll call it security, while also having the upside potential of working with one or more businesses. So this is what we're talking about, is how do you put these projects together? The money's coming from people who are trying to get better tax outcomes, and they're trying to find projects to put them into, but these are not necessarily going to be the best projects from the standpoint that it may be in a distressed economic community that may have other challenges that is inhibiting the ability to get money in there ordinarily. But as I was talking with Michael before tonight's program, we're not seeing money go into projects that would not have received money otherwise, meaning that just because you get a tax incentive doesn't make a bad deal a good deal. If the business doesn't make sense, if it isn't economically viable, if it isn't going to generate a rate of return, no one's going to invest in it anyway. What we are seeing is that there's a number of opportunities, businesses and properties, that may have had a lower ROI, and because of the tax incentive are now making a higher net return to the investor after 10 years, which makes them meet the criteria of investors, and therefore there's a larger group of investments which are now visible to these investors and more opportunities for them to invest. And some of these will be things that are worth doing. But they have to have the underlying quality of the deal or they won't work. So what we do in the first part of the program is we allow people who are doing projects to come up here and do a 5-minute showcase. And essentially it's a quick summary of here's what we're doing, this is cool, please contact us afterwards and let's see what we can do to work together. And tonight, Michael is going to be our sole presenter of a showcase. So what I'm going to do now is I'm going to stop talking, we're going to move microphones around, and Michael will give us a summary of what he's all about and answer any quick questions, and then we'll move into the rest of the program.
I'm Michael Graham. I'm glad to be here. Sorry, Karl, that you invited me back so quickly, but I liked it so much the first time, and it was successful for us from a number of realities. Number one, we discussed our investment. There were people in the crowd sitting in the stands that wanted to invest. We had a fund. They invested, more than one of them actually. So it was, you have a successful platform. You know, don't get discouraged. And you know, it's innovative what you do, and I enjoy doing it. We also as a matter of getting together with investors, we find it's a very difficult thing. And I've been doing this most of my life. And raising money is hard. Getting money from one side of the table is hard. And if you haven't done it before, opportunity zones are great talking points, but the reality is the deal has to make sense to the guy with the money. And anything else is just talk. And so, there's a lot of negotiation that has to happen, and there's a lot of misunderstanding around this whole Opportunity Zone platform. I read it, I learned about it 18 months ago, maybe 18 months ago, February, March of 2018, actively got involved because I just bought a large parcel that was in an Opportunity Zone. I didn't know an Opportunity Zone from a, Karl, what are some of the other things that people mistake them for?
Enterprise zones.
Enterprise zones and other derivative government tax deals that have people would say, I know what that is, and I go, yeah, explain it to me. And so, I said yes to a lot of speaking engagements. We've been to Los Angeles and Dallas. Where else have we been? New Orleans, Denver. We're starting our own educational/investment convention. When will that be? June 19th? July 9th. Okay. Well, I was close. It was in the summer. This summer. And we're starting a webinar series. And the reason we're doing it is to provoke the same thing you're doing, to provoke interaction with all of the people that we've activated, to answer their questions, but more importantly, to say, are you in or are you out? Do you want to invest? So the convention is all about, I grew kind of tired of going and speaking for an education summary when, if you really love something and you have passion for it, all that information that I'm talking about is on the web. It's in Congress. It's in the public domain. If you want to read about it, read about it. But if you want to invest, we're going to have deals and money, matched up, so maybe there'll be some spark. We have, as I said, a 287-acre project called Avalon, which is at DIA. Not at DIA, it's at 64th and E470. It goes from 64th and Piccadilly down to 56th. As a company, we've done another mixed-use project out there successfully, 180 acres. The Gaylord Marriott opening was a game changer. None of us quite know exactly what kind of momentum that's going to create, but the fact that they have 19,165 people a week coming in and out of those doors has to do something, and what it does, according to the operations people, is it creates a great need for entertainment. People want to be entertained. So if they're there for 2.5 days stay, the only place to take them, according to Marriott, is 10 miles away right now. We're less than a mile away. We're right down the street. So we're creating entertainment facilities as well as living facilities and 5 different product types: hotels, entertainment, apartments, and another a lifestyle center later in the project. So what I'm going through now is back to reality, the 180-day capital gain window that I'm really trying to bring some awareness to. And I'm not a CPA or an attorney. So if I misstate some of these things, check your own facts. But there's a 180-day window to invest certain capital gains, and that closes arguably June 28th. That would imply that if you had a K1 from a partnership last year, 2018, you have until June 28th this year to invest that money. There's a lot of people looking for a good deal. How do you find them? How do you match up with it? I think that's the purpose of this whole seminar. Per IRS regulations reached to date, people who have received gains through a pass-through entity in 2018 only may have until June 28th to roll over gains into a QOZ fund. we have a fund. We have an income fund. We opened it about 3 weeks ago. It took us 8 months to get there. It was hard work. It was hard because of the regulations weren't entirely written. We had to go through large law firms. We did so, hired the best we could find, and found people in Washington, D.C. were kind of sitting in the rooms when they'd have these meetings, so we didn't have to wait for clarification on certain issues. And then we looked around and said, single asset deals are getting funded. Large apartment deals, large parts of Inglewood, California are getting done. A lot of projects back east were funded last year. All single asset deals as a category by and large. So where does that leave the rest of the Opportunity Zone world? It leaves us about 7 months for an investor to get a maximum benefit out of the program as designed, unless the dates are extended by Congress, which I wouldn't bet for or against at this time. But this is reality now. Anyway, the next slide is our Gravitas Fund. And in the Gravitas Fund, we have an entire 287 acre that we broke apart, 5 separate funds. One's a hotel fund, one's an entertainment fund with probably having Live Nation as the anchor tenant in the deal. There's another project in Irving, Texas that was built recently that we went and saw, Courtney and I, one day, and it's you wouldn't think of it in the changing landscape of retail as an anchor tenant, but it puts asses in seats. People want to be entertained. They want to go see live music. And in our mind, there's a couple of groups in the world that do it better than anybody else, so that's who we talk to. We have hotel fund. We have income fund that's active. We raised $1 million in the first week. We also have a 95-acre portion of this project that, because of structure, and I'm trying to limit this to 5 minutes, but my head's full of information. We are in order to qualify for the fund, if you've got into the nitty-gritty of underwriting, you know that the Treasury and IRS don't want an owner-developer to be the fund manager. So we're selling off 95 acres with contracts in order to qualify. The rest of that project of the 287 acres will be QOZ properties. This is in a QOZ zone, so arguably someone that bought it would be eligible to start their own fund if they wanted. And what we have, it is pre-sold to one major home builder, 493 lots. That qualifies us. We're selling it or taking 20%. You can take up to 20% and still be involved. We all know about we started our income fund by doing a lot of data on particularly Aurora, Colorado, as it relates to a lot of new homes being built all around us in QOZ. The fact is, according to the Aurora Economic Development Council, everything from DIA south to I-70 is an opportunity zone. There will be 110 to 150,000 new people living out there by the year 2050. We looked back 10 years and saw the average appreciation in particular area code was 10% from 2008 to 18. They're still at the low end of the market. So we monetized it, raised money for it, put a loan to it, and that's part of the income property. We're going to hold it for 11 years, and then we'll either distribute or not, keep going. Minimum investment's $50,000. There's a pref that'll be paid between year 2.5 and 3, cumulatively of all your money, of 8%. The multiple we project on this deal at 11 years is 3.5x. Investment terms 11 years, and you guys can read for yourself. The net investor IRR is 20.3. Our equity raise is 20. 7 of that is debt. The rest we're providing 7 of it's equity. We're providing the debt of 13. And the funding deadline is coming up June 15th, 2019. This is the component of the music and the entertainment with 2 hotels, about 600,000 square feet of development. This is an actual of a site that we're going to design similarly, but this is in Irving, Texas. The challenges. Do you want to talk about that now?
Later.
Later, okay. So, in summary, we're very busy and active in QOZ. We found some stumbling blocks, putting a lot of time into opportunity zones and not dealing with your core business. But it's almost like there's no way to go back once you start, because you have normal transactions that people like to get the best possible tax benefits as they can. Once they know that this is a QOZ, the expectations are ginned up tremendously. So if you sell someone, well, you could have capital gains in 3 years of 4x on this deal, or you could be in a zone and defer your gains indefinitely. Which one are they going to want to go to? So it's kind of, you got to understand the psychology of the greed of the human being, which this applies to. We haven't talked about impact investing. I have a lot to say about that, but I've more than exhausted my 5 minutes. Thank you.
So this is one of the things I like is I get to comment on the showcases. But what I particularly like about Michael's project and what I call the mega projects is that they can be sliced and diced so many different ways to fit a project to the money, to the investor. Where a smaller project, it's kind of like you fit or you don't fit, and you don't have a lot of choices on how you structure the deal. But if you get into something of this nature where, oh, we're going to have an entertainment fund, and then we're going to have a residential fund, and we're going to have an income fund, and all these other funds, and then you can stack them through the development as well, you could end up in a project of the size with 70 or 80 funds, and it would make sense rather than not, because you're getting a custom match of the investor's interest and desires, type of investment, type of deal structure. All those things can be given this variety, this cafeteria. You have a much better chance of making a match. Where before, if you did it all in one size fits all, it's a take it or leave it. You either match or you don't match, you're in or you're out. And too often I've seen deals put on the table and there's silence. Everybody goes, well, I thought this is what everybody wanted. Well, that's what everybody said, but they didn't quite act on it. So until you write the checks. So a lot of times in putting together deals, we go out and do surveys. We do a mock-up of an investment, and we walk it around the room and say, would you write a check for this or not, in a soft environment where they can be honest about it and tell us what really they're thinking. And they're going, it would be better if you added this or you changed this. We go back, tweak the deal, and then we will run it out. And that's when we sink the money into the attorneys and the CPAs and all those good things. Michael also, as a developer, was a landowner prior to the bill being passed, and so he's got certain things he can't do because there are restrictions within the Opportunity Zone laws. He can participate in a project up to 20% afterwards, so he has to, in fact, take the property, give up control by putting it through a process, and still participate, but he can't necessarily lead that part. But what you can do is you can stack deals on top of each other, so your deal continues, but you're still bringing money in and they're running their part of it, and you're creating a harmony of all these projects working together. And the best projects do create a harmony, and that will last through the 10-year time period and peak, so to speak, crescendo after the 10 years is over. So you're getting maximum value to your investors over a longer period of time, and those are the best projects. So those are the most fun as well. When the Opportunity Zone legislation was passed, for a long period of time, there was no activity at all. And then the first projects that have been funded or that are in the motion of being funded have been all real estate projects. And this is kind of normal because these projects were already in motion and they were all typically good projects that should have been funded anyway. But it caused a refocus of where a building might have been built that was already planned. Instead of putting it outside of a zone, it came into a zone in order to gain the tax benefits. But what we're seeing now with the new rules is there's now a new focus upon individual businesses And we had a program a couple months ago, what was an optimal opportunity zone investment? And if you're looking at this from the perspective of an investor, you're saying, well, where do I get the greatest possible benefits? There's a direct correlation between the most benefits and the most tax savings. So if you have a company that is going to generate lots of profits over a period of time, over the 10-year life, so that when you exit the opportunity zone investment, you are going to get the largest profits, that translates to the largest gain because there's no tax on those profits. So we talked about during that one program that a real estate project is a very good project. It's more predictable, it's got more security in it, so in some ways there's less risk. But at some point, every real estate project is going to plateau on how much value it can actually generate, because once you make the improvements and you enhance the property, usually the appreciation is going to flatten out. It'll still get greater year to year, but it's going to be at a certain level where you can pretty much predict this is the maximum you're going to make in return, and therefore maximum amount of benefit is going to come from the Opportunity Zone project. As you move into businesses, businesses have a potential for a much greater gain. And Jeff's company is an example of one of these types of a project where this project could take off. It could become a ubiquitous app that's used by everybody in the social media world, but across dozens and dozens of different commercial applications. If that occurs, Jeff's company may skyrocket, do the old hockey stick approach, and at the end of 10 years, it could be worth an immense amount of money over the starting point at the beginning of the 10-year time period. And because of that, a project like Jeff's has more upside potential benefit from the Opportunity Zone tax, because if you're sitting on stock that's going up multiple times and now you cash out, all that's tax free. So you actually have a potential to get greater benefit from an Oz investment in a high-flying, fast-moving tech company than you could from real estate. Now, obviously there's risk trade-offs and other things that go into that analysis. And then what's interesting is the Innovation Hub, which was also the subject of an earlier program of the Opportunity Zone Meetup, where we talked about kind of a hybrid situation where you take real estate, but you start putting programs and functions and specialties into it. So it's both real estate project and it's also a high-tech or business-style project. And the Opportunity Zone can act as a long-term de-risking of the real estate, because it should result in full occupancy at the end of the 10-year time period, which will help drive the value of the real estate to a maximum amount. Plus, if it's done in a fashion where you're taking equity pieces or intellectual property pieces in each of the businesses that are participating in that Innovation Hub, you've got an upside potential similar to what Jeff's company has, in addition to the underlying real estate project, which serves as a very core valuation period. So these are a couple things. I want to make some observations before we move to the next part of tonight's program, that we're going to start seeing more hybrids and we're going to see more pure business things, and some of these will have some upside potential that are going to be very, very high. Now, my guess is with the businesses coming in wave 2, we're going to see a third wave of community projects that are going to be coming in behind this. And they're going to be coming in behind because it's harder for community to get organized. The projects they're going to put together are not likely to create high return on investment, and so they're going to be less attractive to an investor who's looking strictly for a high rate of return. But they are going to be there, and they're going to have some other benefits. We're going to talk about that more in the next period. But I expect to start seeing a wave of community projects towards the end of this year and climbing through the end of next year, over the next 2 years, as more communities figure out how to employ opportunity zones to their advantage and take advantage of this. For those of you who have attended tonight's Opportunity Zone Meetup, what I'd like to do at this time, now that we've completed the regular part of tonight's program, is to share with you some resources that may be helpful to you in either understanding the rules or finding some service providers or doing anything else that's related to putting together a campaign. At this time, one, I'd point out that the state of Colorado, the Office of Economic Development and International Trade, has a website that they've set up to support people on investing into or receiving money from Opportunity Zone funds. The website is here. Again, you'll get the slide deck by download, so this will be in the stuff that you'll get, so don't worry about getting it correct. But they've done an excellent job. Jana Persky started working with us early last year under Stephanie Copeland, and she's been promoted to director of that department. Compared to other states, it's difficult to say or express just how much of a great job they've done and how superior job as I've seen in some other states. So a lot of information here. You'll find news articles, grant applications for communities where you can get some matching dollars to do your local planning, different downloads from other websites that are doing a good job of finding and posting information in this area. Another one, interactive map of Colorado. You can find one on the state site, but this is a site that was put together by Ross Hare of Oz, Colorado. He's added more data into his website, so you can get more information than what you're going to find on the state site. And his areas are in blue where the state's in yellow, but they're the same areas. But lots more information on his site. Then video recordings. As I mentioned, tonight's program is recorded. That's what Steve is doing for us now. It takes him generally about a week to 10 days, and it's generally me. That's the reason why it takes the longer period of time. But this is all recorded and edited, and then it'll be posted up on YouTube on my channel. It'll be the Karl Dakin channel. But again, I'll send out an email message once it's posted, which will include the URL links for each part of tonight's program. And then more information, if you need to reach out to me, I'm happy to take questions, introduce you to other people I know. This is the URL for tonight's meetup group, where you can join the group and become a member without charge. And as a member, you'll get updates, you'll get referrals to documents and other things that come out. And there's a lot of information already posted there. We're also building a library and opportunity zones on my website for Dakin Capital. And finally, my email address and phone number is at the bottom. So thank you again all for coming to tonight's program. And I hope that you'll find everything here was good information. Feel free to bring people to the next program. We're going to try to drive up our membership through the summer. And we're going to try to build up our subscribers on YouTube. And as we see more projects, we'll have more information to share. And it'll become a better knowledge source for everyone. Thank you.